If you're thinking about relocating to South Carolina to enjoy retirement in your golden years, then this video was made especially for you. This time of life is an incredibly exciting transition. It also can potentially come with some challenges as far as how to financially plan. So in today's video, I am talking to one of my favorite lenders ever, Stephanie Medlock from Benchmark Mortgage. Stephanie and I have worked on countless deals together. She is who I personally used for my own home when I purchased earlier this year, and she has over 20 years of experience in the mortgage industry. So she is super savvy and is here today to share all of her knowledge with us about all the things you need to know when it comes to getting a mortgage and qualifying for a loan in your retirement years. A little planning goes a long way. So we are here today to provide this information for you in hopes that it will give you more confidence to move forward. And of course, if you want to get in touch with Stephanie, all of her information is going to be listed in the description below. If this is your first time to the channel, my name is Sarah Newman. I'm a local realtor and team leader here in the Charleston area. And our team loves helping people just like you with your buying and selling needs. So if we can be of service to you as well, then all the links you need to set up a free consultation are also in the description and pinned in the comments. Without further ado, let's get into today's topic with Stephanie. Welcome back to the channel, Stephanie. Thanks so much for being here today. I'm really excited to talk about all things retirement and financing. We both have the pleasure of working with clients who are retiring, often moving from another state. South Carolina is such a big retirement destination, and they have a lot of questions about, of course, the financial side of retirement. Usually at that point, they're moving into a fixed income, and they just have a lot of considerations of how to manage their money moving into retirement and purchasing a new home. So I'd love to kick things off with you sharing with people, how do people qualify for a new home when they don't have their W-2 salary that they're used to or some kind of job income to qualify?
Yeah, so we have a lot, of course, don't we wish we were retiring, Sarah, right? But yeah, so we have a lot of people that relocate to the South and Charleston specifically for retirement. So sometimes they're on a new job and they're just relocating, which makes it a little bit easier because believe it or not, COVID changed everything, right? So when we left the COVID years, there was people like every once in a while that could work from home. Now it's just a known fact. It's like, I would say probably 70% of our clients are relocating and they work from home. So, in a lot of cases, we just closed one last week where the client hadn't even started their job yet. So they hadn't even gotten their first pay stub, and we were still allowed to close on the loan based on a really good job offer that didn't have any contingencies. But when it comes to retirement, it's a little different and it can be a little trickier. So you definitely want to plan in advance and start this process a little earlier because you don't have your standard, W-2s and pay stubs and consistent income each month. And so the couple of things that we look at is for retired people is we look specifically, obviously, at Social Security being number one. But as we all know, everyone's varies. And so sometimes Social Security alone is not enough to get you to the price point that you want. And so in a lot of cases, too, we can gross up your Social Security. So what we do is we take your Social Security awards letter that you received in the previous year. And if that's your only source of income, then sometimes we can gross up 25% because most of that is not being taxed if you don't claim any other income. And so, but obviously just using Social Security in 90% of the cases is not enough to get you over the hump, right? So a lot of times our clients will, they might have a pension. We're in those days where, people still do get a pension, and a lot of it, you can easily qualify with the amount they get from their pension and their Social Security. But if they don't have a pension, but let's say they have a Roth IRA or traditional IRA, and they're age 59 and a half, they can actually set up distributions, because technically speaking, you do not have to pull from your IRA until you're at the age of 73, and then they force you to take it. But if you, let's say, wanted to take that out earlier and you had, $500,000, let's say, in an IRA account, and you're not currently receiving any kind of distributions, what we look at is we try to find out how much on top of the Social Security do they need to qualify for what their needs are here in Charleston. So if they're trying to buy a $600,000 home and Social Security income alone will only get them to, let's say, $300,000. Sometimes we can advise them to do an IRA distribution where they can call their financial advisor and get it set up to where we get a letter stating, hey, we're going to receive $3,500 a month in IRA distributions. All you have to do is get one withdrawal from it. So we show that you've taken that first withdrawal. So all you got to do is show 1 month's receipt. And then the biggest thing is you have to have a 3-year continuance. That is the biggest thing. So you can't, everything in our lending world is based on, will it continue, right? Because obviously if we're doing someone's, that has a job, they could quit their job tomorrow. We can't control that, but we want to know, how are they going to continue making these payments if their income is going to change next year, right? And it can always change, but we're looking for consistency. So if you're pulling $3,000 a month out of your IRA, that's $36,000 a year times 3. So we're going to need, over, $100,000 just in that account that's left prior to our closing. And so that's the biggest thing, is having the consistency of the income for doing an IRA. But that really helps people get over that hump and helps them qualify for a higher purchase price.
Yeah, that definitely makes sense. And I think a lot of people do that. A lot of my clients anyway, they have things like the IRAs, the 401ks, things that they were set up with maybe in their job, years ago. So they do have those assets to lean on. There is something else called asset depletion. Can you explain what that means?
Yeah, so that's a really cool thing too, where conventional loans and other ones as well, they allow us to take asset depletion, which is where, let's say you have money that's liquid and it's just sitting there. If it's completely available in liquid, so you're thinking like non-retirement accounts, right? So if it's in a brokerage account of some sort, and we have 500,000, they will let us, in some cases, Fannie Mae there's 2 conventional routes. You have your big Fannie Mae and Freddie Mac. And so they view it a little differently, but the standard one I normally go to when I need more income is Freddie Mac, because they allow us to take the full amount of assets that you have available and divide that by 240 months. So in a scenario where, let's say they had 500,000, divide that by 240, we have about 2,083, I think, a month in income now that we can use as income to help you kind of get over that hump. So asset depletion is something we've been using quite a bit of in recent years here.
Wow, that's really fascinating. That's something I wonder about too. Some people do invest in the stock market and have these accounts at Robinhood or Vanguard or wherever it is, and there's certain ways that they can use that money to qualify. Are there any, on that topic, just anything to watch out for, things that they shouldn't do if they do want to use that money that you would advise against?
Yeah, I mean, you definitely want, I am a loan officer. And so, I always advise people when I'm telling people and advising them on taking any sort of money out, you always want to check with your financial advisor, because in some cases, it may not make sense. You might just want to put that asset towards the house, or not do that at all, because there are some tax consequences. Like if you're not, before 59 and a half years old, and depending on what type of IRA account is, like what type of account it is, because you could get taxed on a certain amount, or you might have a 10% penalty if you take it out before that age. And so, and another thing, like you mentioned, the 401k, that is a really good tool to use too, because you can take money from your 401k. You can't really set up a distribution with it like an IRA, but you can set up where you can take money out typically to buy a home and use the down payments from your 401k. But I always advise, speak with your financial advisor, because if you have a portfolio that's going really, really well and you're making a lot of money on it, that might not be your best option. And so I always tell people, talk to your accountant, talk to your, person that handles your IRA and your brokerage accounts to make sure I'm not hurting you and giving you advice when, you could be pulling a large sum of money out. So just kind of be careful of those things.
For sure. And in the last video we did talk about how to use your equity in the home. So for anybody watching this that also has a high amount of equity in their current property, they can cue that video up next to learn the tips and tricks of how to maybe they could potentially not have to touch their investments with the stock market and things. If they have a lot of equity, they could lean on that instead to make the move and the transition.
Yeah, because you want to pull it from the bucket that's making you the least amount of money. And if you have a lot of equity, like we talked about in the last video, just sitting there, it's not doing you any good. It's not making you money. It's not in a brokerage account. It's probably not losing money, which is great, but it's just sitting there, and you can get access to it. Like in our last video we talked about. So if you have a great portfolio and you're like heart set on not selling any of your stocks and you love the way it's performing, then yes, tapping into equity if you have a current home is a fabulous option, and probably a better, smarter option if you're going to have to pay some penalties.
Yeah, for sure. So then how about the clients? Sometimes they are retired from maybe their main career that they had, but sometimes they might have a part-time consulting gig, or maybe they just feel like they're going to be bored in retirement, so they want to work part-time at the Publix or just something to keep them busy. I know I have clients like that. So can you share a little bit more about using, additional income when you're retired, especially if it's part-time?
Yeah, it's so funny. Like I always wonder like how I'll be in retirement, because I see people all the time. I'm like, why are you going back to work? They're like, because I'm bored. Like what am I going to do? But I think I could find something. But yeah, so a lot of our older generation, they do have extra jobs just to bring in a little extra cash or to meet people. And so, if you have a part-time job, you want to make sure that especially if you're relocating. Now, if you're just retired and you pick up a part-time job and you're about to buy a house and you're already moved here, you can absolutely use that income. Where it can get a little tricky is if you're working part-time, we want to see a consistency. So you don't technically have to have a 2-year average of having that part-time job, because that's your only job. Where you would run into issues if you had 2 or 3 part-time jobs and you're trying to use all of those, because the lender's kind of looking at it like a majority of people can't withhold having 2 jobs for a consistent amount of time. And so they typically want to see a history. But if it's just a part-time job, let's say working, 18 to 24 hours a week, then you can use that income. Where you want to be careful though, is you want to make sure that you've had a consistency of it. So if you're working, let's say 20 hours, and then you show us a pay stub for the next 2 paychecks that are only 14 hours, we're going to see a decline there. So you want to make sure it's consistent, because they're looking at qualifying you based on working, let's say 20 hours a week, making $20 an hour. So that's the income we're using. So if we start to see a decline in that, we're not going to use it all together. And you also want to make sure it's something we can verify, like no cash under the table. So if you're working, and cutting people's yards, you don't want to just get cash. You want to show it on a W-2, because if you start receiving variable income or getting paid through like a 1099, you're absolutely going to have a 2-year history of that. So just kind of be careful about that. But a lot of times people do work part-time jobs. I would say probably more than half.
Yeah, and we'll have another video coming up on self-employment and the pitfalls to look for, because that's definitely something that we see a lot of. So if that is of interest to any of you watching this, stay tuned for a future video talking all about self-employment income. So for our retirees, I'd love for you to talk about getting the 30-year mortgage. I think there's maybe a myth or questions about, hey, I'm 70 years old, and are they going to give me a 30-year mortgage?
So the 30-year fixed mortgage is our most go-to mortgage, because it amortizes your payment over a longer period, allowing you for lower monthly payments. And so a lot of times, it's so funny. The other day, I was actually dealing with a client that's like 84 years old, and she's like, well, I would really like to do a 30-year mortgage, but because of my age, you'll probably force me to do like a 10-year. And I don't think I could afford the payment. So because of the Equal Credit Opportunity Act, it absolutely prohibits based on any type of age or anything. So you can buy and do a 30-year fixed mortgage if you're if you're 30 years old, if you're 60, or if you're 90, or if you're 95 or about to celebrate your 100th birthday, I doubt you'd be buying a house, but you can do whatever you want. And the 30-year mortgage, I really love it because it allows for so much flexibility. If you want to try to build equity and have your home paid off to maybe leave for your children, that's all great. And I can show you how to do that through other tools by utilizing the 30-year fixed and making additional payments each year. And you kind of get to the same point. The 15 years offers a slightly lower interest rate, but we can, and I've done it myself on a home here in Mount Pleasant, where I just put X amount of dollars where I was able to pay that home off in a 10-year period. So we can do that in ways without, tying you down to this really large payment on a 15 year. So the 30 years definitely going to be something that especially retirees are going to want to look really hard at.
Yeah, it's nice to have the option to pay more without the obligation to have to pay more, just because life throws you surprises. Maybe you need to end up using that money for something else, and then you're not committed to having to spend extra on your housing payment. But if you have the funds and you want to do an extra payment or two here and there, then you have that flexibility to do that.
Because the goal too, when you're retired, hopefully, is to enjoy your retirement, right? And be able to travel and go do the things that you've always wanted to do without being tied down to, a larger housing payment. So I just think it allows for a lot more freedom to set up your mortgage that way. And again, if you want to pay extra, you absolutely can. Each month when you make that payment, there's a little area that says additional principal. You just slide that in there and put it towards your principal each month, and it will pretty much do the same thing as a shorter term mortgage. But I do like it because, that way people can enjoy their retirement,
For sure. I love that. So can you tell me about the reverse mortgage option? It's something that I've heard people talk about, and I think there's a lot of confusion around what that actually means.
So a reverse mortgage is kind of exactly what it says. It is basically someone that has a lot of equity. They can either utilize it through purchasing a new property, or they can do it through a refinance. And so let's say someone is in a home and they have a ton of equity, like $600,000-$700,000 worth of equity just sitting there. Well, they can't have access to it unless they sell it. So a lot of the times, older people will just say, well, let's just go ahead and sell the property and downsize, even though they might not want to move. But in reality, they don't have to do that. You can do what's called a reverse mortgage. And what I love about this is one time we salvaged a home from a veteran that was about to lose his house, and it was literally in foreclosure. And it is not credit based. They are just really looking at how much equity you have in the house. And what I love about this program is there's no monthly payment. So it is basically using the equity that you have earned and gained over the years, and it's paying your mortgage payment on your behalf each month. So it's literally, let's say you put down, if you're buying I'm just using an example to make it easy, a $500,000 house, and you only want to have a $100,000 mortgage. Once you put that $400,000 into that mortgage, you have no access to it. Okay. So if you want to put it down so you can have a slightly lower mortgage payment, that does make sense. But now your money is not accessible. So you've put all that money down. With a reverse mortgage, how it works is if you do a reverse mortgage and you have access to all this equity, now your equity is working backwards for you in your favor, and it's actually making your mortgage payments each month as you go forward. It even allows for taxes and insurance to be collected through that, so that you don't ever have to worry about paying a tax bill or insurance bill. You're literally, instead of now, let's say, living in a property that was going to cost you $3,000 a month, now it's not costing you $1, and you're still living in the home you want to be in for the rest of your life. And so it's really a great tool that a lot of people don't know about, and they don't take advantage of it. It's probably one of the best programs I've ever seen. And two, there's so many times where, like that veteran, we saved his home by utilizing reverse mortgage. He couldn't afford the monthly payments anymore because all he was receiving was Social Security and a slight amount for disability from the VA. And he literally could not live each month. He could not make his bills. But he had over $400,000 in equity in his property. So he would have either been foreclosed on and he would have lost every bit of his money, or we did the reverse mortgage and now he gets to stay in his home and take advantage of that equity that he's gained over the years. So I love the program.
That's incredible. I love that you get to help people with these options they didn't know existed, and it's just completely changes their life. And that's just amazing. I love it so much. So you can
Oh,
mortgage a home like you just talked about, but if somebody wants to use a reverse mortgage on a new purchase, they can also do that, correct? They just have to put down a very substantial down payment.
yep. Typically, if you want to do it as a purchase, you want to put down about 50 to 60% to really make it make sense. So, we're only talking about if someone has 20% equity, this isn't the best loan for you. That's not going to work. And you have to be older, so it's one of those things where it's not a one size fit all for everyone. But if a lot of people are sitting on a ton of equity right now. And so most people will have enough equity to do this. But if they only have, and I know 20 to 30% equity is a lot of equity in a home, but it's not enough to do a reverse mortgage. And so it's more people that have upwards of 50, 60, 70% equity in their home.
Okay. And they have to be a certain age. I want to say
Yes.
maybe
So they
60.
have to be at age 62 to do the reverse mortgage. And so if you're 62 years old, and only one of the borrowers has to be 62. I believe that's right, Sarah. If not, you're going to have to edit that part. But yeah, so 62 years old is normally the norm to do a reverse mortgage.
Awesome. Are there any other tools that we haven't covered in today's video that you think would be helpful for retirees to know about?
Yeah, I think it's just people, sometimes we don't plan in advance. And so, sometimes you think you might work for a little bit longer and you decide to retire early. The biggest thing I can tell you is, if you're going to retire, I had someone recently, they don't have a pension. They didn't have an IRA, right? So there are times where, if they know that, I thought I was going to work 5 years, but due to some health issues or his wife passing away, he decided to go ahead and retire early. But they don't technically know that you're retiring at your employer yet, right? And so my advice would be, if it's on your radar or there's anything in your life happening right now that could cause you to retire a little sooner, and that you're going to end up moving, you probably want to pull the trigger on that prior to you retiring if you're not going to be getting enough in income to offset the loss of your job. So it's super important that if that is on the radar for you, you really need to think hard about setting that up prior to retiring, because it's just like we say all the time. I mean, we can't control when people quit their jobs. We could close in a loan today and someone gets mad at their employer tomorrow and now they've quit their job, and we can't control that, which is why we make sure they have good credit and that they have enough assets to do that in a case where if they were to lose their job or someone were to fall ill in the house. So you want to make sure you're planning that in advance, because we could help a lot of people and say, hey, instead of retiring right now, let's find you a home, get you settled over the next 3 to 4 months, and then you can retire. And just so that we're not setting them up for failure. Because the worst thing, you can do is, that you need to downgrade in a home because you can't afford that mortgage, or you want to sell it to take advantage of some of the equity. And then, not be told the right information first when you could have, known to maybe do something prior to. So that's probably my biggest advice and challenge that we see is people, need to talk to an agent and a lender prior to making these big life decisions, because there's some advice we can give that makes your life a little bit more simple. So that's probably the best advice I can give on that.
Well, I love that. I think that's a good place to end today, is that solid advice. So I really appreciate your thoughts on this. And as always, I'll post your contact information below in the description. So if anybody wants to reach out to you, they know where to go find your information. And thanks again for being here today. I really appreciate it.
Awesome. Thanks, Sarah. I appreciate you so much. And thanks for having me.